Good evening, everyone. I'd like to welcome you all to the second webinar of the series this evening. My name is Nathan McCartin, and I'm a Drystock Advisor based in the Longford office. I'll be your host for this evening's webinar. Our speakers this evening include Conor Dobson, Drystock Advisor based in Longford, Donal McCabe, Drystock Advisor also based in Longford, and Michael McGreevy, Senior Accountant from IFAC in Roscommon. The topics to be discussed this evening include an overview of TAMS 3 that will be covered by Conor, updates on planning permission and additions to TAMS 3 that will be covered by Donal, beef farm profits and tax planning, which will be covered by Michael, and then the question and answer session at the end of the webinar will be covered by myself. The webinar will last roughly an hour. So don't be afraid to submit any queries or questions you may have on any of the topics discussed. And just to let you know, any questions that are sent in are visible to ourselves, but are anonymous to the audience. There will also be a video recording of this webinar tonight. You can access this on the Roscommon Longford YouTube channel and on other social media platforms such as Facebook and X. Also, just to mention, the final webinar of the series will be taking place next Monday at 8 p.m. and the topics to be discussed on next week's webinar will be an update on TB on farms and the new veterinary medicine regulations. So without further ado, I'll pass you over to our first speaker, Conor Dobson, for his presentation on an overview of TAMS 3.
Thanks, Leighton. I'll just share screen here with you.
Yeah, I can see that, yeah.
Yeah, okay. Thanks, everyone. So look at what my presentation tonight is, just to give a brief overview of the TAMS scheme, and Donal will pick up on certain areas later on. So basically, I'm going to give an overview of the TAMS 3, the Targeted Agricultural Modernisation Scheme. It's Ireland's main on-farm investment scheme. It's part of the CAP strategy, and it supports modernisation of infrastructure and supports modernisation of infrastructure and supports improvement in environment. So what it does then, it improves farm competitiveness and efficiency, enhances environmental performance, promotes improvements in animal welfare and farm safety, supports climate action and renewable energy, and supports young farmers in the Young Farmer Capital Investment Scheme, women farmers, and the organic sector. So the Organic Farming Capital Investment Scheme. So it's made up of individual sub-schemes. Each sub-scheme has its own eligible items and grants rate, and farmers apply into the sub-scheme that matches their investment. So we have animal welfare and nutrient storage, low emission slurry spreading, farm safety, and say the Organic Farming Scheme. You have Young Farmer Capital Investment Scheme, Women Farmer Capital Investment Scheme, and again the Organic Farming. Sorry, no. So 40% is the standard grant rate. There's 60% grant for targeted areas, be it young farmers, women farmers, and organic farmers. Farm safety and solar also come on under this, and the new nutrient storage, which Donal will talk about later, is a 60% grant. Typically up to 90,000 per holding of a spend, or higher limits for partnerships. So Applications are submitted online via AgFood. Operates in tranches. So we have normally 3-month tranches or 3-month application windows. Applications are ranked. Before this, before all the previous tranches we had, and we've had 9 of them at this stage, there was everyone got approval, but now applications are ranked, so it's not a first come, first served basis. Approval has to issue before work can commence. Investment completed after approval. Claim submitted online via AgFood. Inspections can take place up to 5% of applications get inspected either prior to approval or at claim stage, and grant payment issued after approval of claim. So basically, completed investments, I suppose these are typical investments: slurry and slide water storage, animal housing and cubicle houses, cattle handling facilities, farm roadways and yards, solar PV systems, fencing and farm water systems, and less slurry equipment. So basically why TAMS 3 matters, it helps meet nitrates and environmental requirements, supports lower emissions and nutrient use on farm, and improves labour efficiency and future-proofs farm safety. So I suppose the key messages is plan early, choose the correct sub-scheme, ensure investments meet the farm specifications, and use Teagasc support to maximise benefits. Thank you.
That's great, Conor. Thanks for that comprehensive presentation on TAMS 3 and just giving us an overview of it. So we're just going to go on to our next speaker there, Donal. If that suits, you can come on and do your presentation. Yeah, I can see it there now, Donal. Yeah, that's great.
Lovely. Well, look, good evening, everyone. Look, I know Conor there just was kind of outlining I suppose the main aspects of TAMS in terms of the various tranches and some of the different areas that you can apply to within TAMS. So the Farm Safety Capital Investment Scheme and Animal Welfare and Nutrient Storage Scheme and that. So look, what I'm just going to touch on is some of the relatively recent additions to TAMS, and also just change of the planning permission requirements as well. There's a few questions since came in there about a month ago or so. So look, I suppose the first thing that I'll talk about is the enhanced grant aid for nutrient storage. Now, this is actually in a while. It's in nearly 12 months at this stage. But judging by the questions that I get asked on a regular basis, there are a reasonably large cohort of farmers that maybe might not be that familiar in terms of the actual enhanced grant aid under this measure. So essentially, the grant aid is for nutrient storage. So that could be slatted tanks, it could be circular stores, circular towers to hold slurry, it could be manure pits. Anything, I suppose, that is capable of holding slurry or farmyard manure. And it increases the rate of grant aid for those facilities from 40%, let's say, for your typical applicant under the Animal Welfare Nutrient Storage Scheme. So this would be the case if it wasn't an organic farmer or if it wasn't a young farmer. So it gives them a chance to avail of the 60% rate of grant aid for those facilities now. So as I was saying, it includes slatted tanks, circular slurry stores, manure pits, heavy duty slabs and slats also. And I suppose the reason that they come into it is that in theory, if you were applying for grant aid for one of these facilities and you construct, let's say, a slatted tank, from a safety perspective, you couldn't obviously leave that tank open. So you will be actually granted it as well to put slats and slabs on those storage on those tanks, and you'll get a 60% rate of grant aid for the slats and slabs as well. Now, they have to be be conscious. They have to be heavy duty slabs or slats, and the reason for that is they have to be able to withstand the weight of a tractor. So if you have a tank constructed there and slats or slabs put on the tank, the department will they'll want to know that if something came in to the yard and they drove up on those slats or slabs, that they'll be sound. You know that you're not going to end up damaging the slats or worst case scenario going into the tank. What a lot of farmers aren't aware of as well is there's actually a separate ring fence ceiling under this measure as well. So what I mean by that is typically, let's say 18 months ago, if a farmer came to me and said, well, look, they were thinking about putting up a slatted shed. I would say it was a reasonable size shed. We'll say it was, for argument's sake, just we say a 6-bay single. And I would have said, well, look, you're going to be capped here with a ceiling of 90,000. So in other words, the department's costings, the max that they were going to give was 90,000 for that whole job, for the tank, the slats, and everything above it in terms of the shed. So that was the ceiling under that measure. Under using the enhanced grant aid for nutrient storage, as per the last point there, that ring fence ceiling of 90,000, that only relates to nutrient storage actions. So what that means is that you could actually draw down a grant of up to 60% of 90,000 for your slatted tank, let's say in this example, and then you'll also have another 90,000 to play with for putting a shed over that. So in a sense, it increases that it doubles that ceiling in terms of slatted sheds, from 90,000 to 180,000. So you can go up to a max of the costings on the tank can be up to a max of 90,000 that you get paid on. Now that would be an exceptionally big tank, but that's the ceiling that's there on that. And then you'd start from scratch then when you're going putting the shed over it, assuming that you haven't drawn down any other TAMS funding under any other measure that you would have applied for and proceeded with. That would be deducted from that 90,000 ceiling as well. So there is separate. There's a higher ceiling for registered farm partnerships. That's what the RFP is there. So if you're in a registered farm partnership, that can be with a young farmer or without a young farmer. So for the nutrient storage there, you'd technically be able to get 60% of a grant for the tank and the slats on an investment costing up to 180,000. So the way TAMS work is it's 60% of the receipted costs or 60% of the department's costings, whichever is less. But look, it is a fairly generous ceiling that's there. And then for your shed, then if there was a young farmer on that registered farm partnership, well then you'd be able to draw down the ceiling there would be on the first 90,000 you'd be able to draw down 60%, and then on the that should be 160,000. Apologies, not 180,000 there. On another 70,000, then you'd be able to draw down a further. The costings there would be 40%, and the remaining 70,000. But that ceiling is in addition to the ceiling for the sheds, let's say. So it will, particularly for bigger outfits, for bigger developments, it does significantly increase the amount of TAMS funding that can be drawn down on those investments. And look, you'd know that by there's have been a good few more inquiries for sheds and that now in the last 12 months when farmers heard that they could have availed of that higher rate of funding. So just a little bit then on the re-roofing of farm buildings. So this was announced in December there by Minister Hayden, and this measure is built into the Farm Safety Capital Investment Scheme, and it gives grant aid of 60% So subject to the ceiling within the TAMS Farm Safety and Capital Investment Scheme of 90,000. Again, that should be, apologies, 160,000 for a registered farm partnership. Now, the costings on that in terms of so again, just to kind of remind you, it's 60% of whatever the department's costings are on the proposed job, or the receipted costs and own labour as well, whichever is less. So if you were looking to do a full job on that shed in terms of that you were looking to include the cladding, purlins, rafters, stanchions and electrical wiring in your job, so that you were to put in essentially a brand new shed up, you get a grant aid. The costings are €98, 18 cent per metre squared. For roof cladding, purlins and rafters, so if you weren't putting up the stanchions in that case, or the wiring, €60 per metre squared. If you're only putting up the roof cladding and purlins, the costings is €40 per metre squared, and all side and gable cladding only. So if it's only just the side cladding that you were looking to put up, if the roof of the building was sound and you're only looking to replace the side cladding, let's say if it had been damaged during the storm, and the gable cladding, the costings there is €40 per metre squared. So it'd be 60% of that, subject to the ceiling. Now, there is a couple of conditions that is attached to this particular grant aid, and look, it's worth noting them anyway. It is putting a few people off this grant, particularly for smaller sheds. And one of the main sticky points, I suppose, with some farmers in regards to this grant aid is you will need planning permission or planning exemption in all cases. So let's say you could have a building and it could have been grant aided, we'll say maybe 20, 25 years ago, not grant aided, sorry, it could have got planning permission 20 or 25 years ago. But if you're looking to avail of the re-roofing grant, you will need planning permission on that building again to put the roof on it. So that is a requirement under the scheme. So you do need either planning permission or planning exemption. If planning permission isn't needed, and I'll go into the rules on planning permission just very shortly, then planning exemption would suffice, but you're going to have to go to the county council first and get them to verify that you don't need planning. But that is a core requirement under that grant aid, is that planning permission is required, or planning exemption. It's not available for buildings previously granted in the last 5 years. Now, look, unless you're very unlucky, I wouldn't imagine there'd be too many buildings that would need to be re-roofed if they were built within the last 5 years anyway. But it's just to kind of emphasise that if you did receive grant aid in the last 5 years, it's not going to be eligible. Chartered engineering report will be required at application stage when it is proposed not to replace the stanchions or rafters, or when the building did not have any stanchions in the first place. So the typical example there might be let's say an old stone building, maybe an old byre that's still used. If there's no stanchions, or if you're not going to replace the stanchions, if you're not proposing to do that, you will need a chartered engineer's report to verify that the building is structurally sound at the application stage. The building proposed to be re-roofed cannot contain any internal agitation points for slurry, so just be careful there in regards to that. And also, just a point there, remember to appoint a project supervisor to oversee safety on the design and build. So look, there's not time to go into huge detail in regard to the project supervisors, other than any job that is taken more than 30 days, or more than 500 person hours, or that poses a particular risk. So look, putting up a shed, you could argue, does pose a particular risk. They're supposed to have a project supervisor appointed to oversee the health and safety on that job. Now that isn't a TAMS requirement as such, but God forbid if anything went wrong in the construction in the re-roofing of that building, look, a farmer could find themselves liable. Insurance is unlikely to be adequate on its own, if you haven't your project supervisor in place. So just to finish on a little bit in the changes to planning permission requirements as well. So again, they were announced there recently. So essentially, the changes that were made to the planning permission requirements increase the thresholds by 50%. So if you're looking to build a shed, let's say, if you were looking to build a shed in November, we'll say, if that floor area of the shed was more than of a slatted shed, let's say, or a loose house, a cattle shed, if that floor area was more than 200 meters squared, this is now last November, then that building would automatically need planning permission. Just due to the nature of the size of the building, once it exceeded 200 meters squared, planning permission was automatically required. Nothing else needed to be looked at. It was automatic in planning permission. So that threshold has been increased from 200 meters squared to 300 meters squared. Okay, so, but if that building is on the same class, so if there's other farm buildings in that yard that are housing cattle, again, last November, before these changes came in, if that aggregated floor area, including the new building, was more than 300 meters squared, then planning permission was automatically required, but that's been increased to 450 meters squared now. So let's say, for argument's sake, if you were constructing a new shed, 220 meters squared now, just to put a figure on it, and it brought your total floor area for cattle in that yard up to 440 meters squared, you're a good bit off the public road. There's no other planning requirements in place there. Then technically, you know, you don't need planning in those cases. So as I said, the threshold is increased by 50%. In terms of standalone slurry storage tanks, the regulations now will state that farmers can construct these tanks up to 1,000 meter cubes. So that's a million liters essentially, without needing planning, providing that the total farm storage on the farm in terms of slurry storage and manure storage does not exceed 1,500 meter cubed. It's important to note that planning exemption or planning permission is still required when constructing manure storage facilities or sheds under TAMS. So some people were of the opinion that when these regulations came in, that it meant that, look, planning was no longer a requirement, planning exemption or planning permission was no longer a requirement when making a TAMS application. That isn't the case. So you still have to go to the county council beforehand and you have to verify, well, look, this doesn't need planning. So that would be your planning exemption. Or if it does need planning, then you'll need your full planning permission before you can proceed with a TAMS application. So it's just important to note that the changes to the planning permission requirements is essentially just to increase the thresholds in terms of the floor area of the sheds by 50%. So it's just, I suppose, relaxing the rules a little bit in terms of where planning permission is required. But as I say, when you're making your TAMS application, the department will still look to see that you went to the council to verify that you have the planning exemption or full planning permission in place before the application can be made. So hopefully that clarifies that point. If it doesn't, I'm happy to take any questions on it. And also, obviously, I'm happy to take questions on everything else that I would have covered tonight as well. So look, thanks everyone for your attention, and sure, we'll talk to you later.
Great, Donal. Thanks a million for that very informative presentation in regards to planning permission and the re-roofing grant there as well. So just on to our next speaker there, Michael. Maybe you might start sharing your screen there and we'll get on with the presentation there.
We're good there, Nathan?
All good, Michael, yeah.
All good. All good. Great. Good evening, everyone. And I'd like to thank everybody that's joining us tonight online And I'd also like to thank the boys there in Teagasc for extending the invitation to me to be here this evening. Now, as you can see there from my first slide, I'm looking at beef farm profits in 2025. And I'll be looking at these additional profits, and I'll be looking at any additional taxes that's due on those additional profits in 25. Now, I think it's quite an apt topic to be asked to present on tonight, because we're all aware of those buzzwords from last year about historically high cattle prices and unprecedented prices. And there's a common theme, I suppose, occurring in our network of offices nationwide, and I'm hearing it from ag advisors as well, about questions coming from farmers about will I have higher tax bills to pay in 26 on my 25 profits. So what I'm going to endeavour to do tonight is to give a case study or an example of a farmer who has got higher sales figures in his accounts. They're resulting in higher profits and resulting in a higher tax burden on him. And what I'm going to do then is I'm going to look at 5 ways of minimising that tax burden or alleviating the tax bill. Now, the example I'm going to use tonight is a farmer who's farming a 20-cow suckler herd. He's producing 20 calves every year, and he's selling those 20 calves as weanlings in the back end of the year. Now, he's a part-time farmer. He's working off farm Monday to Friday, and he has an annual salary of 44,000 per annum. Now, he's a single man, as I said, or woman. In this case, we'll say he's a man for tonight. And why I'm picking the figure of 44,000 per annum is the fact that this is the cutoff from when you start paying the higher rate of tax at 40%. So at the moment on his 44,000 salary, he's paying tax at 20%, which means that for every euro that he earns in addition to this on farm, he's actually going to be hit with circa 50% tax rate. And that's made up of 40% income tax, and the balance is made up of USC and PRSI. So for every euro that's earned over and above the 44,000, he's actually going to be paying 50 cents over to the revenue commissioners. Now we're going to look at how his sales have arisen in 2025, the additional sales. And I think everyone is probably would appreciate now that, the price of, be it weanlings, stores, heifers or cows, they've all increased about €1,000 per head from 24 to 25. So in the case of this man, 20 weanlings at an extra 1,000 a head, that's coming in at an extra €20,000 in sales in 2025. And what we're going to assume is that his costs against those sales have remained stable. Feed, fertilizer, vets, medicines, contractor and rent, they've all remained the same. So basically, if you take an additional 20,000 in sales and you're subtracting the same expenses from that, well, you're going to have an additional profit, bottom line profit of €20,000. And as we said earlier, because he's now on the high rate of tax, the tax associated with that at 50% is an additional €10,000. So this farmer is going to need an additional 10,000 in the kitty, as it were, come the end of October 26 to pay that 10,000. Now, before I move on to the methods of reducing this tax burden, I want people to be clear on the difference between profits and cash flow. Profit is what you pay tax on, and that profit comes about from sales less your expenses. And it's at this point in time that the revenue commissioners want their slice. They want to be first in to get the slice. So you pay the tax at that point in time. Now, cash flow is money that's left in the bank after the tax is paid, but after you make bank repayments and then you live, which is really that you spend on personal drawings. So what's left in at the end of that, that's the money in the bank, that's the cash flow. And that's where this man is going to need the additional 10,000 to come from in October. So be very mindful that if you have higher profits and a higher tax bill, it's going to be October when you will need to come up with the money. So be very careful, I suppose, that you don't go out and maybe buy a piece of machinery out of money that's there in the bank, forgetting to have to pay the tax bill in October. There are times I would have clients, business people and farmers coming in to me to say, I can't have a tax bill. I shouldn't have a tax bill because there's no money in the bank, or I'm in an overdraft situation. Unfortunately, that's not always the case, because there is that difference between profit, that's what you pay your tax on, but the money that's left in the bank is after you've made your repayments and your drawings. Bank repayments and drawings are not deductible from the point of view of tax. So just be mindful of the difference there. And don't forget, extra profit is a good thing and it's well deserved. And I suppose it's up to us as accountants then to minimise and to reduce the tax bill on those profits. So how to protect this extra profit and reduce the taxation burden? And as I said earlier, I'm going to look at 5 ways. The first one is family wages, 2nd, stock relief, 3, income averaging, 4, paying into a pension, and 5, investing in facilities and safety improvements or machinery on your farm. Now, it is the case that if we're going to reduce the amount of tax that we pay to the revenue commissioners, it may necessitate an outlay of monies to someplace else. And what I want to demonstrate tonight, that this money is not dead money, as it were. But of these 5 options here, 3 of the options, family wages, pension and facilities and safety improvements, will necessitate an outlay of money or a spending of money. But what that will do is it will prevent the money, or I suppose we'll try and reduce the money that has to go to the taxman. 2 of the options here, stock relief and income averaging, they come at no cost. And you will see that in a minute as I go through the examples, but they do not necessitate an outlay of money. So family wages. Many family members provide essential, often unpaid help. Paying them a formal wage towards their contribution and creates a deductible expense of the firm, reducing your tax bill. And I suppose for 90% of the farmers, the help that comes on the farm comes from inside the house. You're not really employing people from outside the house. You know, you're looking to sons and daughters, or you're looking at spouses to help on the farm. Now, this is a very useful tool. It's a great mechanism at reducing a tax bill, because by paying wages, and I'm going to use the example to a son or a daughter or a niece or nephew, you will get an expense for that amount of wages, just the very same as if you bought 2 ton of fertilizer or 10 ton of meal. It goes in as an expense in your profit and loss, which reduces your profit and reduces your tax bill. But there are key compliance points, and they are: you must comply with the PAYE modernisation rules. You must register the family members on your payroll, and you yourself must be registered as an employer with revenue, and you must pay the wages directly into the bank account of your son or daughter or the family member, whoever it is, and you must report it to revenue. Now, if this is set up correctly from the start, there's a great tax saving measure here, and it also gets money across from the farm business, from yourself to your son and daughter. There may be at times when your son and daughter or niece or nephew, that they're in college, that you would have to give them money anyway for college accommodation or for fees or whatever. But in this case, if it's set up correctly, if you follow the compliance points outlined here, you will get a deduction in your accounts, and you are getting the money across to your son or daughter for them to invest in their futures or to pay for themselves in college. So the example bottom here is, if you pay a family member 8,000 in wages, that can be deducted from your sales, goes in as an expense. It reduces your profit by 8,000. And if you're at the high rate of tax at roughly 50%, there's a tax saving of roughly €4,000. So in paying out the 8,000 in wages, it's really only costing you 4 because you're saving 4,000 in tax. But it's a great mechanism for reducing your tax bill and for getting money to the next generation, as it were. Stock relief then, this is an allowance on the increase in your farm stock value from one year to the other. So you would look at your stock valuation at the start of the year, say at the 1st of December 25, and if it's valued at €100,000, you will look then at the 31st of December. And if your stock values have gone up to, say, €110,000, there's an increase or an uplift in stock value to the tune of €10,000. Now, all farmers out there are entitled to a 25% reduction of that 10% of that 10,000 against their profit. So, in effect, 25% of 10,000 is 2,500. So, therefore, that 2,500 can be deducted from your profit and therefore reduces your tax bill. If you are a partner in, for example, a registered farm partnership, that 25% is doubled to 50%. And the reduction in profit is 5,000. If you're a young trained farmer, you get the full 10,000 as a deduction. You get 100% stock relief. So the 10,000 can be deducted from your profit, reducing your profit by 10,000. And if you're at the high rate of tax, there's a tax saving there of €5,000. Income averaging then, and again, this, like the stock relief, doesn't necessitate any outlay of monies. And income averaging is, as it suggests, it averages your profits over a 5-year period. Now, this becomes very valid where there is a spike in profits. And as you can see here, if you look at the years there, 21 to 25, and the profits in the next column, you'll see there in the first 3 years, the profits are fairly steady. But in 2025, the profit has shot up to 42,000. Now, if in 25 we're to use that actual profit for the year, the tax bill on that at 52% is 21,840. You'll see it there in the third column. But the revenue will allow us in farming to average that 25 profit with the previous 4-year profits. So when you add the profits from 21 to 25 inclusive, the average profit in 25 is 27,000. And revenue will allow you to use that profit on your return of income for 25. So the tax at 52% on 27,000 is 14,040. So you can see the difference there. On the actual profit of 42, the tax is 21,840, but on the average profit, which we can use, the tax is reduced to 14,040. So there's a tax saving there of €7,800. The next tactic then is pensions. And this is where you can use your current high profits to invest in your retirement. And basically what it is, it's paying a certain amount of money into a pension in a particular tax year. And if we go down there to the bottom right-hand part of the screen there, you'll see the potential tax saving on a 5,000 contribution is €2,000. So really what it is, for every €1,000 that you pay into a pension in the particular tax year, it will save you 40% in tax. So 40% of every 1,000 is €400. So for every 1,000 you pay in, you will save 400 in tax. But as I said, this is an example of where you have to spend money to save money. So you're putting money or spending money into the pension to save money in tax. Now you will note there that this is calculated at the 40% tax relief, whereas in the other examples, the relief was obtained at 52%. The reason being that a pension payment is only efficient or can be only deducted from your income tax. It does not make a saving against PRSI and USC like the other options did. So this is at the 40% rate, but it's a great way of reducing tax, and it's a great investment in the future. It's an investment in yourself. and your future, that you'll have a pension when you come to retirement. Facilities and safety. And everybody is aware that there are capital allowances to be got when you build sheds or when you buy machinery. For instance, if you buy a tractor and it costs €100,000, well, that 100,000, it cannot all be written off against profit in the year that it's spent. It must be written off over an 8-year period. So when you take the 100,000 and divide it by 8, it's €12,500 that you're able to deduct from profit for each year for 8 years. But there is a scheme there at the moment where there are accelerated capital allowances. And again, accelerated capital allowances is where we speed up the allowance. So for instance, there are some examples of farm safety equipment where the cost of that equipment can be written off over 2 years. So if the equipment costs 10,000, you can deduct €5,000 in the first year and 5,000 in the second year against your profits. And examples of these safety equipment would be backing bars for crushes, hoists and lifts for tractors to be able to change tires safely on tractors, head scoops on crushes, etc. Now there's a list of those, and they're there on both the revenue website and I do believe the department website as well. But it is an example of where you can get accelerated allowances. And again, this is an investment in the farm. It does necessitate spending and an outlay of money, but it is saving tax. And again, to promote safety and the revenue are accelerating the allowances to give you the relief quicker. Now, look, if you have farmers then that may have used and the 5 options above and can't go any further with them, you may have farmers as well who have high profits over a long number of years. It may be a good time to start to look to see if you have the correct structure for your farm business. There are 3 structures: being a sole trader, a partnership, or a limited company. The sole trader is the way a lot of the farms would operate. It's the one-person operation and all the profits are taxed in that person's name. There are 2 types of partnerships then. There's the registered farm partnership, which is registered with the Department of Agriculture. It has a tax registration number, and there would be a partnership agreement in place which would dictate or which would say from the outset as to how the profits would be split. So by bringing in one or more people in, we can spread the profits out between people, therefore reducing the profits that one particular person or 2 people would have. The other example of a partnership would be a joint herd number, where you would have 2 people in the partnership. It's unregistered, no formal agreement in place, and the profits are split 50-50. But again, it's reducing the profit on one person and perhaps spreading it out to reduce the tax burden. And of course, a limited company then, well, I suppose the advantage here is that the tax is at 12.5%, which is a lot lower than the 50 or 52% we saw earlier. It's not for everybody. You would have to look at the circumstances and the situation. And the farmer actually becomes a director of the company in which he would take a salary and rent from the company, and the profits belong to the company. So again, as I said, maybe look at the structure of the farm and look at the 3 different structures that are there if you have high profits for, we'd say, a number of years, and you have every other option utilised. So I suppose, look, to sum up, and the key takeaways from tonight is to know your figures. Look at your sales, your 25 versus 24. You know, if your sales are up, well, you know, and if all your expenses have remained the same and everything else has remained the same, you know, you more than likely are looking at higher profits, perhaps a tax bill that you never had before, or a higher tax bill. Also, a very good way to look at things is your bank account. Look at it at the start of the year, how much money is in the bank, and look at it at the end of the year. And again, if everything else has remained the same, you know, it's going to tell the tale as to that you would have higher profits. Review those options 1 to 5, the income averaging, the paying into a pension, and so on and so forth. Invest. As I say, family wages is investing in the family. Paying into a pension is investing in your future. Investing in machinery and safety equipment is investing in the farm. And look at your structure. Sole trader versus a partnership versus a limited company. And I think on that note, that finishes me for tonight. And I want to thank you all for listening. Thank you.
Great, Michael. Thanks a million for that informative presentation on farm tax and I suppose tax planning going forward. So basically what we're going to go do now is go and do the Q&A session. So there is a right few questions after coming in. We'll probably start off maybe with Donal and Conor in regards to TAMS questions. So just the first question that came in there, either you can answer, I suppose, whatever suits. For a livestock monitor or calving camera, does it have to be installed by a company or can you buy one and install it yourself?
Yeah, oh, sure. I can take that one, Conor. The terms and conditions would state that own labour isn't permitted for the installation of a calving camera. So the department, when you're completing the TAMS claim, you won't be able to claim for your own labour. Now, once the calving camera is detailed on the invoice, it'll be up to the department inspector to look for their own detail in terms of the company's involvement in the erection of the camera. But essentially, as I was saying there earlier on, the grant that you can draw down is in a calving camera's situation, it'd be 60% of the receipted costs or the department's costings, whichever is less. So if you were just purchasing the camera and looking to install it yourself, number one, you're running the risk that the department will look to see proof that it was properly installed, which it probably should be. And secondly, as well, obviously your receipt is going to be an awful lot less if you're only purchasing the camera, which leave you with a lesser grant.
That's great, Donal. Thanks. Now, just the next question there how can you apply for an extension to the date to erect a building? So I think that's in regards to an extension on the actual application.
Yeah, I could take that one, Nathan. Basically, I suppose before your time is up, you can apply online for an extension or whatever. So basically, if you have some work done, it's a matter of uploading an invoice, to say the work is started or whatever, be it for purchase of concrete or purchase of slats or whatever if you're doing a building. And then you just upload to geotag photographs of what you've done so far. In other words, the work has commenced for the department or whatever. So look at normally if this is done before the 11th month of your 1 year approval and uploaded online, you get a 6-month extension. Similarly, if you have paid a deposit on machinery and you're still waiting for the machine to be delivered, say a proof of a deposit will suffice as well. So there is options. I suppose the main thing is tacked in time before your date is up or whatever.
Great, Conor. I think that answers that question. So just another question in there. How does the rankings work for TAMS 10 and when will the farmers find out about TAMS 3 Tranche 10?
Yeah, so TAMS Tranche 10, that closed for applications in December. I think it was the 5th of December.
Yeah.
It's typically about 3 months after that before approvals could be expected to be start issuing. Now, it's often near 4 months. And around that time, 3 months after the tranche closing date is when the department will fully make up their mind in terms of what budget they have for all the various applicants. So you're talking, probably will be into the end of February at the very earliest, but more than likely into March before that decision is made. Now, you can bring up, if you Google the TAMS, let's say if it was animal welfare nutrient storage, TAMS animal welfare nutrient storage, and then go into the marking sheet, you'll see where the points are awarded and deducted. Now, it's impossible to say where the marks will sit at for this tranche because it will depend on the number of applications in and the value of those applications as well. So that's why I suppose it takes the department a while to kind of tabulate all that, those figures, to be able to decide exactly how many approvals that they'll be able to issue. But the marking sheets are there. I suppose looking at the marking sheets for the various enterprises, what I can see is the marking sheets seem to favour, which is a bit of a change to TAMS too, seems to favour the lighter stocked farmer and the farmer, the smaller holding as well. In TAMS 3, which so the opposite really applied for TAMS 2. But I don't know, Conor, is that what you're seeing as well in terms of marking sheets? So
yeah.
Look, as I say, impossible to say at this stage, who'll get in. But if you're a smaller farmer and not too intensively stocked, your chances will probably be increased.
Great. Thanks for that, Donal. Just there as well, can you get TAMS on a new tank dug out in an existing shed if the agitation point is going to be outside the shed?
I'll take that one. Yeah, look at there's no problem. Yeah, as long as it meets the department specifications or whatever, and once the agitation point is outside, yeah, there's no problem with a new tank in an existing structure. Yeah.
No more than any other tank, you will need your plan permission or plan exemption in advance of that. So just to be conscious of that.
Yeah, great, thanks. Is there a TAMS grant available for a machinery shed?
No,
No.
it's simple. No, it's simple. That's
exactly. No.
Yeah. That's grand. And just kind of the last question really on TAMS there. Small shed with tank put up 5 years ago without planning and is under the threshold for required planning. Should letter or notice be sent to the council at the time? Is there any action required?
No, is the simple answer there. So it's just not to confuse the two. See, the department, and you can completely understand why this is the case, I can anyway, will look for planning permission or planning exemption first because they don't want to be responsible for grant aid in something that the farmer is assuming that didn't need planning, which probably did need planning. So the Department of Agriculture will get you to verify, will get the council to verify before the application is submitted whether that building needs planning or not, or whatever structure it is. If you're confident that if you weren't applying for TAMS, which it sounds like in this case that you didn't apply for TAMS, you just put up the shed off your own bat and you're confident that it fell within the thresholds that I was talking about earlier, then there was no requirement to contact the council beforehand because it's exempted development. But as I say, the difference with TAMS is the department need that proof. So they can't go on hearsay to say for a farmer or for an advisor to say, oh yeah, look, that's grand. They need the council to verify that. But as I say, if you're not going through TAMS and you're confident you're within the thresholds of planning exemption, then I wouldn't be concerned about it.
Okay, Donal, thank you. So we'll just move on to the questions there for you, Michael. To pay a wage to a family member in 2026, did they need to be registered before the end of 2025? And is it too late for 2026?
It's not too late for 2026. They can register now for going forward, basically.
That's grand. What age must your child be to pay them a wage from the farm?
Look, we'll say about 16. There's no hard and fast rule. We'll say about 16.
Okay, that's great. And just kind of a more of a statement. Also on tax, I presume to reduce the 2025 tax bill, the wages, pension, or facilities should have been paid in 2025.
Is this pension now that That to do with the pension?
Doesn't say now. It just says the 2025 taxable, the wages, pension, or facility should have been paid in 2025. What he's getting at there.
If it's the pension, they can pay up until the end of October 26 into a pension that'll cover 25 tax. So they can pay in, if it's a pension, pay that pension in any time up to the end of October 26. That'll go against the 25 tax bill. But wages, you can't go back in retrospect. So you can only get registered now for 2026. It won't work for 25 at this stage. You'd need to be registered in the year to pay the wage in the year to get the relief for it.
That's great, Michael. Just another question in there. What is a reasonable amount of wages per child that can be included annually in expenses for the farm?
Well, look, it depends on the hours. You know, the son or the daughter or the child has to be seen as if it was an employee that was brought in from outside. So, you know, you would be looking at the minimum wage that should be, you know, they should be keeping records of hours worked and calculating it then per the minimum wage for the particular age of the child.
That's grand. It's kind of similar questions come in that you've already answered. If I didn't sell any stock for 2025 and just carried them over, is the value of them taken as income and taxable, or is it only when I sell them?
Well, they're taken in as part of your closing stock at a value at the end of 2025. So yes, they would be, even though they're still in stock, there is still a value taken in on them at the end of 25 and you're taxed on that. It goes back to the example I gave about the stock relief there. You will get relief on the stock relief part of that. Right. If that makes sense.
So there's a lot of questions in here now. 1 second. Can you sell machinery and sheds to a limited company and get a cash-free payment for it or rent for it?
Generally, what you would do if you were to form a limited company, you would have to transfer the sheds, or not the sheds, but you would transfer the machinery into the limited company. Because the limited company will need the machinery to trade, to carry on its business. And yes, you can transfer them in at a value and take that money out of the company. So while the word sell, we wouldn't use the word sell, but we would say transfer in, and you can take that money out of the value of that machinery at any time from the company. Sheds we would not transfer into a limited company. Buildings or land would not be transferred in.
Okay, that's great, Michael. Just can you pay a parent in wages?
Yes, you can pay a parent in wages is the answer. Yes.
That's all right. Does registering for VAT I don't know, is registering for VAT useful in reducing income tax?
No, it's I wouldn't put the two of them together. I suppose registering for VAT isn't going to increase or decrease income tax as such.
That's grand, Michael. So that's probably most of the questions there for you. Just one more in regards to TAMS now, Conor or Donal, you can answer this. What are the current estimated timeline of TAMS slatted houses approval, and is there inspections after the claim stage?
Yeah, so I suppose Conor was outlining there the tranches, the windows for applications. So the last window for applications closed on the 5th of December. This current window closed for applications on the 6th of March. So typically speaking, regardless of when in that window you apply, based on the current timeframes that we're seeing lately, it'd be 4 months typically after that window closes where you'd get the green light to proceed with your application. Now, if it's if it's a mobile investment, let's say for argument, head scoop or weighing scales or something like that, you can take a gamble and you can purchase that equipment after you've made your application at your own risk. So you're running the risk there that you won't get approval, and then the investment is kind of up in the air. But that can be done for mobile equipment if you're very anxious to get it. But as I say, at your own risk. For fixed investments like sheds, like fencing, you have to wait for approval on those applications before you can commence work. Otherwise, you're going to receive a penalty. And there was another part of your question, Nathan, was there, in regards to it?
Just go back to that.
On the inspections, Donal,
Oh,
you
yeah,
just said,
yeah.
yes, look at, I suppose, 5% of applications are inspected either prior to application or at claim stage or whatever. So some are inspected, some are not.
Yeah, indeed, you could get inspected, and you heard of some inspections, you can be inspected up to 5 years after you make your claim for payment. So the department are within their right to inspect up to 5 years to verify that you still have what you purchased, that you didn't sell it on, and that you're using it for the purpose that it was granted for as well. So in other words, if it's a cattle shed that you're using for cattle and that you having it full of hay or machinery only, that you have stock in it.
Yeah, so I think that concludes the question and answer session there, and probably concludes really the webinar.
I just saw one question there, Nathan. Sorry about the tax cost of a grant aided shed. For Michael there, was the tax cost of a grant aided shed? Is it net of any TAMS grant received? So that's probably Michael that says for you there.
Look, if the shed is
how is
the TAMS grant is
treated in respect
deducted
of
from the
grant
cost of the shed.
Yeah.
If the shed is costing 100,000 net of VAT, obviously you get your VAT back. So we'll say it's 100,000 net. And if Donal, you're going to get a 60% grant, which is of 80,000, am I right in saying that?
Yeah, well, again, it depends on what your grant is. Yeah, up to, but the ceiling is 90,000, I suppose, for a sole trader.
So the grant. 90?
So if you're hitting the ceiling,
for argument's sake, so. Yeah, if the shed is costing 90,000 and you're getting a grant against that of say 60% of 90, which is 54, 90,000 minus the 54 grant, it's the balance thing that's written off for tax purposes. Hope that makes sense.
That's great, yeah. So that's probably concludes the webinar for this evening. I just wanted to say thanks very much to the listeners for your attention this evening, and I hope you gained some valuable information in regards to TAMS 3 and farms tax. I also want to thank Conor, Donal and Michael for giving their expertise on the topics discussed. So also just to mention, this webinar was recorded and will be available on the Roscommon Longford YouTube channel and on other social media platforms. And I just want to remind you the final webinar next Monday at 8 p.m, where the topics are an update on TB on farms and also the new veterinary medicine regulations. So thanks again and good night.
Thanks, everyone.
Thank you.